Good evening to all the participants. Good evening, sir. We welcome you all in the workshop on futures and options trading strategies. So here to conduct workshop, we have SAURABH JAIN sir as our faculty. Welcome, sir. Happy learning to all of you. And I request sir to start with the workshop.
All right, thank you so much for that introduction. So just confirm if you can hear me. Somebody from the panel can just confirm. My voice is clear and loud enough? Yeah. All right, that's great. Chat box is open. You all can interact with me live during this session. I welcome all of you once again to this small session where we are going to discuss about a few strategies which have been, I would say, highly underrated and downplayed. But I think that those are one of the best strategies which are available in the markets today. And I think that if you constantly follow this strategy, even in today's market where the scenario is that we are at, let's say, 19,000 Nifty, 19,200, we have just touched. Now from here, the upside could be limited, but the downside stays completely open. Now, whenever you have any option strategy in your mind, you have to understand that there are two ways of handling it. Now, if you are an option trader, you either know the direction or you don't know it. Those are the two things you have. Now, if you have a directional sense, like right now, if you strongly feel that 19,000 Nifty level is a level which cannot sustain for a long time, let's say that's what your view is. So maybe the upside is only maximum, it is capped up till 19,200, 400, 600, 800, whatever is your resistance level, which you have in your mind, at the back of your mind somewhere. And I would say that you have a kind of a feeling that due to the global recession, due to the effects of the rising interest rates, there could be a push towards the inflows which are coming in the equity markets. Recently, the equity markets in India have been going up because of a lot of participations by the FII. But the FIIs will eventually, let's say, stop putting in money, and the DIIs would continue to, let's say, take out money. At higher levels, we may not have fresh investors coming in. So there could be some kind of correction in the market or some kind of pullback in the market, which can actually lead towards, let's say, sub 18,000 levels. Could be 17,000, could be 16,000. This is where you can have a directional sense. Now, in certain cases, we don't have a directional sense, which means that we know that the markets will move, but we don't know which side it's going to move. Maybe it's going to go till 2025, 1,000. Maybe it's going to come down to 16, 17,000, but it will move, right? In any of these directions, right? Now, when you are not biased towards any direction, those type of strategies are called something. Okay, what are they called in the world of options? Anybody knows it? You can respond on the chat box. I can see your responses on the chat box. If you all can hear me. When you don't have a directional sense, then you have to deploy some strategies. And I believe that all of you here are option traders, or you're very much interested in the world of options. And that's why you want to know a few things here. Like, for example, some of you may be advanced option traders. Some of you may know nothing about options, but you are very keen to learn about it. There could be diverse people here, but then most of you, I believe, are really interested in options. That's why you're here. So non-directional, some people are saying straddle, some people are saying strangle, some people are saying that we would deploy a strategy which is not biased towards any kind of direction or something like that. I have a good answer. Somebody has written butterflies and condor spreads. Very good. So non-directional strategies, can we call them delta neutral strategies? Have you heard about this word? This word called delta neutral strategy. What is delta neutral strategies? Delta neutral strategies means that we don't have any kind of directional sense, which means that whether going negative, market going negative from here will benefit me, or market going positive from here will benefit me. I don't know, right? Those are called neutral strategies. Neutral means what? Delta. What is delta? Delta is the impact of the movement of the underlying on the option prices, right? Now, suppose if you have a call, right? So if you have a call in hand and the market goes up, you will make money. If the market doesn't go up, you will lose money, at least up till the premium, right? That much is clear to everybody. Now, in that case, which type of delta would you be into a positive delta, right? Your delta would be positive number, right? It could be, let's say if it is an at the money call, then your delta would be 50%, which means 0.5. Can I say that? Right? Because it means that if the stock goes up by 100 rupees, your option at the money call option will, the price of that option, the premium will not go up by 100, but it will go up by 50. Correct? That's 50%, 0.5 delta, but positive, right? Now, if I talk about the delta of a put, that would be negative, right? Because in put, the premium will go up as the market goes down, right? So the at the money put ka delta would be what? Minus 0.5, right? Now, if you buy a call, your delta is 0.5. If you buy a put, your delta is minus 0.5. So what is the delta of your entire portfolio, which is called positional delta? The delta of your total portfolio is minus 0.5 plus 0.5 is equal to 0. That's why it's called delta neutral strategy. Now, in this case, when my delta is neutral, does it mean that whether the market goes up or whether the market goes down, I'll not make money? Is that what delta neutral means? Let me know. Does delta neutral means that whether the market goes up or whether the markets go down, I'm neutral. Neutral means I will not make money either side. Is that the case? Or it means that whether the market goes up or whether the market goes down, I'll make money in either of the cases. Is that the correct thing, right? What does it mean? It means that I'm not biased towards any kind of positivity or negativity, right? Yes, the second one, right? Which means I am not really clear whether the market is going to go up or the market is going to go down. What I know is that markets are going to move, let's say a little bit up, little bit down, sideways, right? Uptrend, I don't know. Downtrend, I don't know. So delta neutral strategies doesn't mean that your profit will be zero, or it doesn't mean that whether the market goes up or down, I will make no loss or I'll have no profit. Delta neutral strategies means that you know the limits between which the markets are going to move, most probably. Now, either you know that the markets are going to stay in those limits, then also you're delta neutral. Or if you know that market can move either upside of this limit or downside of this limit, then also you are delta neutral. So I'll just take my whiteboard here, and I hope that you all will be able to see my whiteboard. Just give me a quick yes or no if you can see my whiteboard right now. Is my whiteboard visible? It is? Okay, great. So in that case, let's understand that for any kind of non-directional strategy, which I generally call, we generally call it a delta neutral strategy. Now, for any kind of delta neutral strategy, it means we are not biased towards a direction. What it means is we can make money, or we could have made money if the market went up. We could have made money if the market went down. We don't want the market to go up, neither we want the market to go down. We want the market to move. We are not biased where it goes, but wherever it goes, I should get money, which means I should earn even if the market goes up, and I may end up earning even if the market goes down. That's what a delta neutral strategy means. Now, in the delta neutral strategy, is it compulsory that the market in that case has to stay within certain limits? Let's say this is where the market is. I know the resistance, I know the support for some reason. Now, I feel that the markets cannot go above this, and if the market falls, it cannot fall below this level. In that case, if I take any strategy in option market, will that be called a delta neutral strategy? I don't know which side it's going to go, but I know that the markets are going to stay within these two limits. Is this a delta neutral strategy? Yes, correct, very good. No, yes, it is a delta neutral strategy. No confusion here. No need to be confused at all. Because in this case, I would take a strategy wherein either the market, if it goes up or it goes down, wherever it goes, if it dies within this limit, which means here the strategy which I'm going to undertake would be that kind of a strategy wherein whether the market goes up from here, the stock, or if the stock goes down from here, as long as the stock dies means expires, right? So as long as the stock dies within this range, I should make money. I should earn. I don't care whether it will go up and then stay down or it will go down and then stay up. It should be within these limits. If that's the case for you to earn, then you need a strategy which is a low volatility strategy. Can I say that? Right? Low volatility, which means you don't feel that the market is going to move much. First stage is that I don't know whether the direction of the market is going to be up or down. Okay, I don't know. All right, it could go up, it could go down. That's first stage. That proves that you should be going for a delta neutral strategy. That's stage one. Now, after going for stage one, and if you have any question, you can quickly put it up on the chat box, else we will take all the questions at the end. Okay, yes, all right. So let's say if obviously whatever we are discussing here is important for those people who are very much interested in options. Now, the word delta, which I had told you, if you are, let's say, from a very, let's say, early background wherein, let's say, your age is not that much also, I'll just explain to you something very quickly. Whenever you invest in stocks, the stock itself is considered to be the underlying asset. Okay. Now, when the underlying asset goes up and down, let's say, the option premiums also go up and down. Now, the rate at which the option premiums, the call and put ka premiums are going to go up and down depends upon the strike price of that option. Okay. And that relationship is called delta. So if, let's say, the underlying asset goes up by 10 rupees and the call which you have, the premium of that call goes up by, let's say, 5 rupees. When the stock went up by 10 rupees, the premium of the call went up by 5 rupees, which means your delta of that particular strike price ka call is 0.5 or let's say 50%. Okay. Let's say during the same time, when the stock went up by 10 rupees, that time the delta or that time the put premium, the premium of a put went down by 5 rupees. That means the delta of that put is minus 0.5. Okay, minus 0.5. Right? Now, delta is basically the responsiveness. You have to have a little bit knowledge of options to understand this. However, if you don't have any knowledge of options, you are absolutely new to the world of options, then you can join some course or read some books on basics of options, call and put. So what we are dealing here with is something which is untapped. I'm going to discuss a very, very good, a great strategy with all of you, and I can just kind of literally shout out my lungs for in favor of that strategy. That I don't know why people don't use that strategy. It is so easy to use. It is available, and you can make a consistent income. You're a college student. You are anybody who has the right to earn, right? And if you are above that age, you could be a trader. You could be an investor. You could be working as a part-time trader. You could be, let's say, working in an MNC, and at the same time, you get some time during the day where you can trade. You can be anybody. You can be in 3 stages. Let's say you have zero knowledge of options. You have intermediate knowledge of options. And you have advanced knowledge of options. Irrespective of your level here, whatever I'm going to cover with you, it can make a little bit sense to you. If you are at zero level, maybe things will only 10 to 20% of things will make sense to you, but you will understand that this is a great way to make money. So you can start your journey today from here and then eventually to here. Okay. If you are somebody who's at the intermediate level, you will really find this very exciting. And if you're somebody at the advanced level of option trading as a trader, then also you may have to wonder once again, or let's say, go back in time and think that why didn't you use this strategy, which was always there, but you always underrated it. Okay, what I'm talking about is a strategy in options which can be used to make consistent amount of money without any directional sense. So you don't need the knowledge of technical analysis for this, but if you have it, it's very good. In case you have knowledge of technical analysis, it would be great. Okay, but then if you don't have it also, the non-directional strategies are made for that only when the markets are sideways, uptrend, downtrend, and sideways. That's the thing. Sideways means no particular directional sense. Okay, now as I was talking about, I'm coming back to my topic here. As I was talking about that time, and all your questions which are not put on the chat box, I'm going to take it at the end. Don't worry about that. We have a separate time allocated for that. So we are relaxed and chill for that. Please keep your questions with you. Don't forget them. I'm going to handle all your questions one by one. So if I feel that the market is going to be range bound within this particular range, but I don't know which side is going to move, but even if it moves up, it will not cross this. Even if it moves down, it will not cross this. But I don't know which side it's going to move. It means I'm expecting low volatility. Volatility means ups and downs. Okay, volatility is not about positiveness or negativeness. Volatility means how much movement is possible, how much deviation or dispersion is possible. Okay, either of the directions. Okay, now in the same case, this is Mr. A, and in the same case, there is somebody called Mr. B who strongly feels that market will not stay in this range, in the same range. Market will not stay here. Either the market will surpass this resistance, or the markets are going to break this support and go down. So either it's going to go down beyond this level, or it's going to go up above this level. That's what we think. Now, in that case, it can do whatever, but it will never die within this range. But I still don't know which side it's going to be. So first of all, tell me, am I still looking for a delta neutral strategy? Am I still looking for a delta neutral strategy? Yes or no? I know that the stock will either go up beyond this level, or it will either go down beyond this level. It will not die within this field in the next 1 month. Next 1 month, Reliance Industry will stay between 2,500 to 3,000. That's A. Next 1 month, Reliance Industry will either be above 3,000 or below 2,500. But it will not stay between 2,500 to 3,000. I'm Mr. B. Fine? Okay. Now this is also a delta neutral strategy, because you can still earn because you are expecting high volatility. Are you understanding this? You are expecting the stock to be highly volatile. It can be going up like this. It can be going down like this. It will do something big, right? It will do something big, but we don't know what it's going to do, which direction it's going to be. But it will not stay where it is. Let's say a situation where budget results are coming in, election results are coming in. Let's say a situation where budget is going to come in. Okay, let's say a situation where a big economic decision or a policy is going to come in. Let's say it's a situation where there is some kind of geopolitical risk, there is some kind of natural catastrophic event, COVID type of an event. There is something big which is going to come, and I don't know whether, let's say, suppose election results are going to come. Now I don't know how the market is going to react with the election results, whether it's going to go up or down, but it's not going to stay where it is, high volatile. Right? Highly volatile. So delta neutral is a different concept. Volatility is a different concept. And when we can tap both of them, we create a super strategy. As of now, do you think that having a knowledge of volatility but not direction is sufficient to make money in the options market? Right? Because we can deploy a strategy like that, wherein in low volatility we can make money, or in high. Now basically the two strategies, actually one strategy, is going to have two faces. If you are a buyer, somebody else is a seller. If you are selling, somebody else is buying. If you are buying, somebody else is selling. So if Mr. A thinks, yes, that the stock is going to be between these two, and Mr. B thinks that the stock is going to be beyond this and this limit, we have a market ready, correct? We have a ready market for this, right? Which means we have created a market. Mr. A will approach Mr. B and say that markets will stay between this range. Mr. B will say, no, markets are going to be outside this range. They can have a bet. And in that bet, obviously one person will win. Now, you cannot be on both sides of the road. You cannot be saying that the market is going to be low volatile and highly volatile. That's not possible. You have to be on either of the sides. But whichever side you are, you have to be clear about one thing, that whatever you have decided in your mind, pursue that. Don't change your perception about the market. If you feel and you're confident of your vision, stick to that. What happens in most of the cases, we are right. The trade which we take is also right, but we don't have the confidence to stick to it. And we get our stop losses triggered. And then the market moves in the same direction where we had seen it from our eyes, but we couldn't believe in ourselves. As a trader, the first thing for you to do is to believe in yourself and your strategy. This is my strategy. I will stick to it. Profit or loss, I'm here, I will take it. Correct? If you enter into any relationship, let's say when you get married, you are confident you're going to marry this person, right? Now, either good or bad, you will have to try your best to work it out till you can, right? But when it goes outside your human limitations, you may need to break it off, correct? Same thing applies here. When you stick to any strategy in options, you are confident that the strategy should work. So whatever it takes within your limits, you should do it. But the moment it crosses the limits of your losses, which you can bear, it goes into a zone which can lead to huge losses, and the losses will magnify to a level which you cannot tolerate. That is the time you should exit your strategy. But till the time you're not exiting, you should do something which is called adjustment. Adjustment is a very advanced topic in options. Okay, most of the people know how to enter or exit, but very few know how to adjust your positions and not to exit. So there is a method by which you have to ensure that if you are delta neutral from the beginning, you stay delta neutral till the end. Suppose right now I'm delta neutral. I took a position, call and put combined. Okay. After some time, the markets moved in such a way that I'm no more delta neutral. So I have to take certain positions on top of the existing positions, which means I have to top up. Okay. On top of the existing positions, I have to take certain positions to ensure that I stay delta neutral. Those are called adjustments. Nobody can teach adjustments to you. Adjustment is something which you will learn on your own when you actually indulge into a trade. Okay? No, my dear, relationships also fluctuate, right? When you meet somebody, you think that this person has XYZ nature, okay? But you have seen them for only 1 month, 2 months, 3 months. When you get married, then you stay with them 24 hours. Then you come to know the exact personality of that person, right? So when we perceive something about the market, we perceive based on our perception of what is going to be in the future in the markets. 2 days later, some new news comes and everything is shattered. Things change, times change, right? Feelings change. So you understand that it is exactly how you try to manage your relationships in life. Market positions using options also have to be managed accordingly. In fact, there are some strategies which are called married put strategy, right? So you have to understand that you have to manage it till the time it is within your limits. Once it is crossed your limits, you have to exit. But exiting is not the correct way to handle a trade. First is adjustment, then exiting. Now, in the cycle of any trader, there are 3 stages. and you have to tell me which stage you are in. Okay. First stage is huge loss. Okay. Second stage is preserving your capital, which means you are at the stage where you are able to preserve your capital. And the third stage is you have in that stage where you have started making profit. Every trader has to go through these three cycles. Correct me if you're wrong, if I'm wrong, and tell me if you feel that you are in that stage, in any of these stages. In most of the cases, I would find people in this stage. Now, in my entire career of last 17 years of being in this field, I have never found a single person in my life who had just started with profit from day one. There are a few random people who claim that on social media. If they want to, they can, but nobody can learn without falling. Once you have to, whether it is driving a car or riding a bike or a bicycle also, ideally you would learn from your mistakes in these fields. So most of the people, they start with a huge loss because of lack of intellectual knowledge about it. Now, because of lack of knowledge but excitement and power of capital, you trade. You think you know everything, but actually your knowledge is only 1% of how much the knowledge should be before you start trading. And you obviously have, starting in the beginning, you have some luck. And after you have that luck factor with you, in the it's beginner's luck will give you some money, you will put more money and you will have a huge loss. Most of the people leave the market there only forever. Many of them, they go to a kind of a place of worship, maybe a temple or a mosque, and then they take a vow, they take a swear that they will never ever trade in the markets after that. This is where you are being tested, my dear. Once you have a huge loss, yes, then you will try and understand that you have to first think of how will you preserve your capital. This is where options come in. This is where options help. Options really help you to preserve your capital. They are the best tool for hedging. You all know it. What is hedging? Hedging means like an insurance. So suppose if you have taken a position in cash market, you bought some shares, you can hedge your positions with options so that if there is a profit, you will get it. If there's a loss, you will not have any loss, which means if the market goes up, you will make profit. If the market goes down, there will be no loss. There is a possibility of doing that using hedging. So options can be used to hedge and protect your capital. So the first thing after falling, which you should learn, is how to preserve capital. Once you have learned the art of preserving your original capital and paying as less margin as possible as a trader with as less capital as you can, then you will be promoted to the third stage eventually, where you will start making profits. And when I'm talking about profits, I mean literally only profits, which means you will take only those trades you know you're going to make money in. That stage will come maybe after 1 year, 5 years, 10 years. For some people, this stage never comes also. So some of you here are saying, sir, I'm in stage 1. Some of you are saying I'm in stage 2. The best way is to understand by making an investment diary. You make an investment diary where you're writing your mistakes so that you don't repeat them for the next page. And for this, you have to start with paper trading. Do your loss in paper trading, no? Which means don't put your real money. When you have had a very big loss in paper trading, you will realize that you still need to learn a lot. So many people say that, sir, when will I understand, or how would I be knowing that I have learned enough that I can make money in the market and I can trade, or I can leave my job or something. So in paper trading, when you have literally made money in 8 to 9 trades out of 10 trades, then you can leave everything else and start trading and use your own money, your real money. Because in paper trading, when you've lost 8-9, when you've gained in 8 to 9 trades out of 10, which means you have some secret recipe, some secret sauce, and you are deserved to become a trader. You are a good trader. In real trading, this will fall. Why? Because in paper trading, when you know that you don't have your real money involved, you can take some more risk, which in real life you will not be able to, because you have to preserve some capital also. You don't want to go all in, correct? You will not want to lose your entire wealth in one day. Even if you want to lose, you will lose it in stages, isn't it? Just like you go to a casino, maybe, right? You keep some money aside, that this is the amount of money I want to lose. Maybe I make a profit, maybe it's just an experience I take from here, but not money. But I will not erode my bank balance, right? So same way, in your actual trading, you will end up having 6 to 7 trades correct out of 10 trades. Then also you'll make money because of your risk reward ratio. If your risk is 5 rupee, reward is 10 rupee, you are on a 1:2 kind of a thing, right? 1 rupee risk, 2 rupees reward. Then also, if you make money in 6 trades and you lose in 4 trades, you'll end up making good money overall. You cannot make money in all the trades, but at the end of the day or end of the week, month or year, you should take home some money. Options help only those people who understand the importance of this stage before they go for this stage. If you have already done this, congratulations, because not congratulations for having a loss, but congratulations, you have passed stage 1. So you can say, sir, what if I've never traded, I've never had a loss? Then do paper trading, you will have a loss. And eventually you will learn how to preserve your capital first, and then converting that into profitable trades for yourself. Whichever stage you are, there's no way you can say that I should be delaying for this and that. When delaying knowledge is delaying money. Because if you take the knowledge today, you can start trading after 1 year, after 6 months, after 3 months, depending. If you take the knowledge after 2 years, you have already lost that period where you could have made money or gained some experience. And that is why it is very important to keep learning. So entry is important. Adjustments are important to stay delta neutral or to stay with your strategy, and exiting when it all becomes very, very difficult. Okay. Now, you may not have heard, or you may have, it depends, of a strategy which is called iron condor. If you have heard about this, many of you, I'm sure, have heard. Some of you may not have. Now, don't run after the name, or don't feel that it is a daunting. Yes, you have heard. So don't. It looks like a very daunting name because it's like a very complicated scheme or complicated strategy or something. It's not. Let me tell you. Iron condor is an extension of a butterfly. Okay. So you all have heard about butterfly. It's a very basic strategy, butterfly. It's not an advanced strategy, but it involves various legs, so people get confused. Butterfly, when you upgrade it, it becomes iron condor. And iron condor, when you upgrade it, then the iron condor becomes iron butterfly. Okay, if you upgrade it, it becomes iron butterfly. All right. I'm going to take your questions at the end. As I said, you can always use the chat box, please. Okay. So butterfly, many people are not very much comfortable with the concept of butterfly. It's all delta neutral strategy, which I'm talking about, not a directionally biased strategy. But many people, they go long in butterfly. Many people, they go short in butterfly, depending upon whether you are Mr. A or Mr. B, correct? A means range bound. B means outside the range, high volatile, correct? So whether you are A or you are B, whatever you are, according to that, you would either long a butterfly or you'll short a butterfly. Okay. Now, if you feel that butterfly never gives you money, then I'm with you in this. Because I feel there's a material defect in the butterfly strategy. I'm not going to get into the butterfly. I'm going to directly jump onto iron condor for you. But I just wanted to give you an orientation of what is the origin of the iron condor strategy. So butterfly is having some defects in it. It's a weak strategy. We move it to iron condor. Now, iron condor strategy, again, has a stage which can lead to a situation where you would want to improve yourself beyond iron condor. Which means, if you ask me which is better, iron condor or iron butterfly, I would say iron condor has a lower risk, and that's why it has a lower reward. But an iron butterfly obviously has a slightly higher risk. The cost is a little bit high, but at the same time, the reward is also very high. So when you learn iron condor, then you will understand how you can upgrade to iron butterfly. And commonly, we call iron butterfly as iron fly. So actually, we need to learn iron fly. That's the one of the best strategy, and the biggest part of iron fly is that you can use it for different types of trades. Suppose you're a trader who trades every day, then also you can use iron fly as an intraday strategy. Suppose you are a trader who uses iron fly strategy to trade once a week. I can tell you how to use it once a week. I'll give you exactly how to use it once a week. I'll tell you, don't worry. Suppose you're a trader who uses iron fly for positional trades for 10-15 days. Till expiry also, you can use that. It's a versatile strategy. It works on Nifty, Bank Nifty, and even for stocks. But stock options, you know that volume and liquidity is a big problem. So try to stick to Bank Nifty and Nifty for iron fly. Whether you are an intraday trader or a weekly trader or a positional trader, it is good for all of you. To understand iron fly, you have to go back in time and understand iron condor. For understanding iron condor, you have to go back in time and understand butterfly. I'm going to take a shortcut here because we are obviously pressed for time. And because we have to understand iron fly, eventually, we'll have to cut it short here by moving directly to iron condor. Okay. So I hope that all of you are ready to understand this. Now, maybe you are using iron condor in some case or the other, but the view which I'm going to give you for iron condor, the explanation, the concept, you will understand that actually it is not a strategy, but it is a kind of an adjustment we are doing to be delta neutral, but at the same time knowing whether the stock is highly volatile or less volatile or whatever it is. So for that, I'm going to use a small material which I have developed just for all of you for this workshop. Okay. So you can see it here that the iron condor has a kind of, you can say, a combination of two spreads. Now, maybe you are not aware of what is a spread. Okay. Let's say, for example, we have bought one call of, let's say, X strike price, and we have sold another call of, let's say, higher strike price, or vice versa, or you do it in put. Then you have created spreads. Okay. Now here also we have created spreads, but along with creating a spread, we have also done few more things. After today, after my explanation today, I'm definitely sure that from Monday onwards, you may indulge yourself into this strategy. Not iron condor, but I would suggest go for iron fly. But even if you do with iron condor, it's not bad. Okay. It's a very advanced strategy. If you don't have any knowledge of options, you should try the basic strategies first, maybe butterfly, then improve your knowledge. So as I said, that iron condor is directionally neutral, defined risk strategy, which means you know how much your loss could be. Okay. And in this strategy, we profit when the underlying asset remains in a range, which means Mr. A, not B. But you can do the opposite of iron condor, then you can become B, because Mr. A will trade only through somebody else who is opposite of Mr. A, which means Mr. B, right? So till the time the contracts expire, you don't need to wait till the expiry, but even if you wait till the expiry, you will keep getting money every day. So what it does is, it is made of a short vertical put spread and a short vertical call spread in a single transaction. Looking at it, it seems that vertical put spread will have two puts and vertical call spread will have two calls, which means that in total, we may have 4 trades taken into one single transaction in a basket order, correct? But all of them will be having the same underlying asset, same expiry, of course. Okay. Now, basically, when you create a call spread, okay, when you create a call spread, your payoff chart looks like this. Green is obviously profit, red is loss. Okay. So let's say if you have a call of this strike price here and you have a call of this strike price. Okay. Now that's a spread which you have created. This is your break-even point. Okay, that's your break-even point. Now, the way you create a spread will decide whether you will be bullish or bearish or whatever it is. So here, if you see, if the expiry is on this side, right side, which means more, the strike price, the expiry price is higher. So if it is below certain value, you are making money. If it is above, then you're losing. Similar to this, we have a put spread also, which we have created. Okay, it's all of the same expiry. So you cannot call it a calendar spread. Okay, what is it? Is it a calendar spread? No, it's a vertical spread, which means playing across various strike prices. Fine. Now, let's understand that when we are trying to play with the different strike prices, we have to be very careful of choosing the right strike price. Okay, so when you combine these two things, the kind of position which you get, which gets created, is like this. Okay, like this, which means that this is where one of the put is, this is where the other put is, this is where your call is, this is where your call is. This is the call you have bought long, that's why green. This is the call you have sold. This is the put you have sold. This is the put you have bought. Now, you know what is the reason why it's called an iron? Iron fly, iron condor, all of them, the word iron. There's a reason for using the name. I'm very bad in drawing anything, but generally, if you have seen people lifting heavy weights, or let's say some, this, like this, that's why it's called iron. Okay, it's like you're lifting something like a curved dumbbell or whatever. I mean, not a dumbbell obviously, but the thing which you lift in a gym, let's say. That's one of the reasons why it's called iron, and another is because it's a great strategy as well. So an iron condor is actually what you are selling call and put, and you are also buying call and put. So the call which you are selling and the put which you are selling here can be considered as having a gap. The gap will, for the call and put which you are selling, will call, or we'll call this selling of call and put as a strangle and not a straddle. Suppose if Nifty is 19,000, if I sell a call of 19,000 and a put of 19,000. So in that case, since both the strikes are 19,000, that's at the money, then we call it a straddle. And you all know that in straddle, we feel that the market is going to go either of the directions when we buy the straddle, but here we are selling the straddle. We are selling the straddle means that we feel that the market is going to be within that particular range and within that low volatility. Because let's say the call ka premium is 100 and the put ka premium is 100. Even though obviously the premium would be different, I'm just making it as simple as possible. So if you're selling a call and selling a put with 100 rupees, in both the cases, you are going to receive 200 rupees premium, correct? Now, as long as the range of Nifty will be between 18,800 and 19,200. If Nifty is here, 19,000 right now, if Nifty goes up to 19,200 also, what will happen? Suppose if the expiry is at 19,200. So what will happen for your call? What will happen for your put? You have sold a call of 19,000, right? But expiry is at 19,200. So the other party will obviously exercise the call. They will want to buy it at 19,000. So you will lose 200. What about the put of 19,000? When the expiry is at 19,200, nobody is going to use that put. So the put will go waste. So on expiry, you'll have to pay 200. But you have already received 200 while you had traded. You received 200 when you traded. You have paid 200 on expiry. So your net loss profit is 0. But if the expiry would have been above 19,200, then you would have a loss. Similarly here, if the expiry would be below 18,800, then also you'll have a loss, right? In put, you will have a loss. So in call, you will have a loss if the expiry is above 19,200. And in put, you will have a loss if the expiry is below 18,800. But as long as Nifty stays between 19,200 and 18,800, you will have no loss, right? In fact, if it expires exactly at 19,000, neither the call will be exercised nor the put, and you will earn the entire 200. Correct? This is a straddle because it is done with at the money. Same strike. Now, if I do the same, but I create a gap between the strikes, which means instead of having 19,000 ka call selling and also selling the 19,000 ka put option, which means put your option, I create a gap between the strikes. Okay, let's say I sell 19,100 ka call and 18,900 ka put. So instead of having at the money, I am going 1 out of the money. For call, a higher strike prices would be out of the money. For put, lower strike prices would be out of the money. Correct? So I'm going 1 out of the money here, and I'm going 1 out of the money here. Now, when I go 1 out of the money, I generally would be having lesser premium, because out of the money will obviously have lesser premium. But now I will have more window to breathe. Correct? Because here I had 400 points ka window, that within 400 points, if Nifty is moving, I will still make some money. I will not lose anything for sure, which means preserving capital. Correct? Now here my window will be a little bit more, right? But it also depends on the premium. Let's say the total premium of call and put together here in this case, because there's slight out of the money, let's say the total premium is 125. So now my range would be 19,000 to 25, and at the bottom here the range would be 18,900 minus 125, which means 18,775. I think that's what it is, right? Correct? So it would be this. Now I have a bigger range. If you see the range now, the range is slightly bigger, right? So I have 225 points here. I have 225 points here. In total, I have 550 points ka window instead of 400 points ka window. But because of creating this, I have received lesser money. Now, even if Nifty dies at 19,000, I will not earn 200, but 125. Correct? But I have more room to breathe now. I'm Mr. A, not Mr. B. I still am delta neutral, number one. Number two, I feel that the market is going to stay within the range of 19,100 to 18,900 or 19,225 to 18,775. So I have more broader support and resistance for myself. Now, in this case, when I've sold the call and put of 1 out of the money, indirectly, what I've done is a strangle. So that's the difference between a straddle and a strangle. Now, in a strangle, I can have one at the money and another out of the money, or I can have both out of the money. That depends. Strangle word has a very large definition. It is very accommodative. Okay. Now, here we are saying we are going to short the strangle. Now, what if a person longs the strangle? A person who longs the strangle will pay this 125 rupees. I hope that you are getting it on the other side. If I had shorted strangle, somebody else would have longed the strangle. Let's assume that. Now, somebody who has longed the strangle of 125 rupees, he has paid 125 rupees and ensured that now, whether the market goes up or the market goes down, irrespective of the direction of the market, if Nifty crosses 19,225 going up, or if Nifty crosses 18,775 going down, in both the directions, in any of the directions, he will have unlimited profit on both the sides. So the person who has gone long in the strangle has unlimited profit on both sides and limited loss of 125 rupees in between. Correct? Which means that the graph of that person would almost be like this. If this is profit and this is loss, this is plus area, this is minus area, this is zero, no profit, no loss. So if Nifty goes below 18,775, he'll have unlimited profit. If Nifty goes above 19,225, he'll have unlimited profit. Correct? But he will have to pay a limited loss if Nifty stays between 19,225 and 18,775. Now, we are not doing this because you cannot lift iron like this. You have to lift it like this, right? So we are not going to long the strangle. We are going to short the strangle, which means Mr. A, not Mr. B. So we feel that the range of Nifty is going to stay between these two areas. Right now, do you not feel that Nifty cannot cross 20,000 on the upper side? I feel at least that is what you feel. And while it is going down in the near term, maybe in the near term, it will not cross below 18,000, right? If you want to become a little bit more wider on this, you can say 20,500, 17,500, correct? Now you have to create a strategy through which you can tap these two ranges. But the problem is, what if Nifty goes outside that range, unlimited profit to the other party, or outside this range here? Plus, because you are selling a strangle, you are selling a call, you are selling a put, so there is a huge margin which you have to pay. When you sell options now, you have to pay a huge margin. Now, to avoid those margins, I will have to buy something also. Okay, I will buy just for the sake of buying, but I will still buy. I will buy so that this unlimited profit stops on either sides. Okay, and at the same time, you know, unlimited profit, how does it look? Actually, if this is 0, okay, unlimited profit would look like this. Unlimited losses would look like this, right? Which means that this is my profit area, limited. Losses seem to be unlimited in this side also, this side also, correct? This is when you short a strangle. When you short a strangle, then when the expiry is below this point, unlimited loss. Expiry is below this point, unlimited loss. But till the time the market stays within the two ranges of this is the resistance you thought, this is the support you thought, whatever, right? So between that, if the market stays, then you will have profit in short strangle. Now in short strangle, the deficiency is we have unlimited loss on both the sides. Now, how can you tap that problem? That problem you have understood, I believe. So to tap that problem, you will have to make the losses on both sides limited, which means that you cannot afford to have this unlimited loss on both the sides. You will have to taper your loss down. On both the sides, I will have to taper it down and I have to restrict my loss. Now it is turning into the shape which we wanted, which means the shape of iron, right? So I want my loss on both sides to be tapered, one, plus I also want my margin to be lesser, preserve capital, and at the same time pay less margin. Those are the two goals of a best option strategy. A good option strategy is the one which can help us in this way, that on one side, a good option strategy is which can have the least possible margin. Second is it should be not directionally biased. Third is that you should be having limited losses, not unlimited, right? So here we have limited profit, but also limited loss on both sides. If we can manage this, for that, I have to buy an option, correct? Right? And obviously to buy an option on both the sides, little bit more extreme, obviously the option which I'm going to buy here and here are going to be out of the money, right? So now let's go back to this here. So the option I'm going to buy, the call, is going to be here out of the money. The put I'm going to buy will be another out of the money. But here, these two would be either at the money or very close to the money. Okay, all right. So when I short a strangle, it would be just one strike below or above at the money, because it's not a straddle, by the way, with long options that are purchased further out of the money, because it means that call and put are already out of the money, but not very far, not very deep. And then I will have to buy two more options, which would be again out of the money. Now, just like with a strangle, this is a great way to get exposure to the stock without a directional position. It benefits from the passage of time, because as the time progresses ahead, which is called theta, that because of the time, the decay in premium will give you money. You don't need to keep it till expiry. Even if you keep it for 1 day, 2 day, 3 day, 3 days, 5 days, the premium of the calls which you have sold, tell me something. Do you realize that the calls and puts which we have sold are more near to the money than the call and put we have bought, right? which call and put will have a higher delta, the one which we have sold or the one which we have bought? Which call and put will have higher delta, higher response? Obviously the call and put which are near to the current price. So if the premiums have to decay, the premium of the call and put which you have sold will decay faster than the premium which are out of the money. Correct? Right? That would happen along with volatility. The impact of volatility will also be according to that. What happens eventually is that you would end up having profit on any of the sides. So the setup is very clear. One call and one put we have to buy out of the money. One call and one put we have to sell out of the money. Right now, let's say this is where Nifty is, let's say 19,000. You'll have to create a strategy according to that. So the setup is basically sell out of the money, call vertical spread. So what is this call vertical spread? This one. And this is sell vertical put. But eventually what is happening here is that we are trying to sell one out of the money put with a strike closer, and we have to buy one out of the money with a little bit far from there. Again, we have to sell one out of the money call, and when we have to buy one out of the money call, which is a little bit more far. Okay. Let's say if I take this example here, right now, if a stock ka price is this, let's say we are here. So the stock ka price is, let's say 500. Okay. And there is 60 days, there are 60 days still remaining in the expiry. Okay. Now, what you can do is you can sell a call, this one, and sell another call here, sell a call this one here, and sell a put this one, and a little bit out of the money, 600 and 400 here, because these are the strike prices, 450, 400, 550, 600. Now, obviously the premiums will create this area here, because obviously the premium of the put seems to be like this much, and for the entire strategy is this much. So the call and put ka premium which I am going to receive for the selling is, let's say 8 rupees here and 9 rupees here, which makes it 17 rupees around. Okay. So that is the premium which I'm going to receive. All right. And the premium which I'm going to pay is also going to be according to that for the options which I'm going to buy. Now, based on that, you will see that we will be able to create this chart here like this. Now, if Nifty goes here or here, if the stock goes here, I'm still making money as long as this is not happening. But even if this is happening, I have a limited loss. This strategy is iron condor, not iron butterfly. Okay. Now, what is iron condor here is clear, but what is iron butterfly, that you have to understand, right? So what is the difference between iron condor and iron butterfly, which is also called iron fly? So iron condor uses the same component as the iron butterfly. The iron condor uses out of the money put and call credit spreads, which we know, whereas the iron butterfly uses at the money put and call credit spreads. What it means is that unlike the iron condor, where there are 4 strikes which are involved, let's say right now if you want to do this trade 19,000 Nifty, I can show you also quickly. And if you want to go 1 out of the money or 2 out of the money, so what you can do is you can, I'm talking about iron condor right now, so maybe one call you can sell of 19,100, you can sell a call, and you can sell a put of 18,900. Okay. And you can buy 19,000, let's say 300 ka call, and you can buy 18,700 ka put. This is what you can do, right? Now, based on the premium, and you will see that the strategy is delta would be close to 0, delta neutral, right? Now, this is when you do an iron condor. But in this, your spread is higher. Okay. Now, if I want to create an iron fly, I will not do this. I will sell the call and the put of at the money, which is actually basically a straddle. So I will do a straddle, short straddle, obviously. Okay. Not a strangle, short straddle. Okay. At the money. So one strike is involved. Which one? 19,000. There earlier it was 4 strikes, right? 19,100, 18,900, 19,300, 18,700. Here we have only 3 strikes. One is the at the money strike, which I'm going to sell. One is out of the money, call and put. Okay. So iron fly will use 3 different strike price. Short, put and call share the same strike price. Short means selling. Maximum profit is the net credit received, and net credit means the premium which you have received, and we will realize maximum profit if the stock is between the 2 strikes. Here also the maximum profit is the net credit received, but the expectation is that this will not happen since one short strike is almost always in the money, right? So what we are doing here in iron fly is going to give you a higher money or reward, but it also has a slightly higher risk because your area of profit is slightly short. So instead of being an iron condor, it is an iron fly, which means instead of having elongated this one, like here it was like this, then we had a area, a spread, and then we went like this. Instead of that, which was there in iron condor, here the area of profit is little bit less, but this height is little bit taller, which means you can get more money. Loss is still limited, but you can get a higher reward. That's the best part of iron fly. So what you do is you sell a straddle, and obviously to cover that, you will buy an out of the money put and out of the money call. This is the thing you can do. You don't need to know the direction, the trend, nothing. Now, if you want to do this on Nifty in really right now, you can do this for at the money call very easily and put. However, I would like to tell you that I have a very strange, great strategy to discuss or share with all of you, which really works excellently on weekly expiry. If you all are interested, I can discuss that with all of you. This strategy will require 0 stop loss. I have back tested this strategy for more than 8-9 years. Okay, myself. I use this strategy most often I use this strategy only. Basically, what we are doing is we are creating an iron fly, or we can call it the iron butterfly. Okay, few more minutes and then we can start taking your questions. Short iron butterfly, you can call it, because we are shorting the straddle. That's why. You don't need to keep any stop loss, nothing. In the last 8 to 9 years, the success ratio of this strategy has been more than 95%, which means that this strategy always works. All right. And this is the only strategy which requires a very low capital, and there is no naked position, which means it's not like you are doing a blind unlimited loss kind of a strategy. Now, whatever iron fly concept which I have taught you right now, if right now Nifty is 19,200 approx, okay, not 19,000 but 19,200, let's say. First of all, the strategy which I'm telling you is a weekly strategy. You have to trade only once a week. I've explained what is iron condor and iron fly. Now I'm going to explain to you how you're going to implement this strategy in the next 3-4 minutes, and then we're going to start taking the questions. So right now, an at the money would be 19,200, sell, call, and put both. Okay, that's what you can do. But when will you do this? So you will do this on Tuesday. Okay, you will do this on Tuesday. Tuesday, obviously, market may not be at 19,200, but I would want you to do this only on a Tuesday, wherever the market is going to be. That time, whatever is the at the money, do that for at the money, and at the money call and put will have a delta of 0.5. Don't forget. Okay. Now you will do it on Tuesday, but wait a minute. You will do it between 3:25 to 3:30 p.m. and as late as possible. Suppose if you can do it at 3:30 itself, literally 3:29, it's even better. Okay. I don't want any fluctuation. Why? Because I'm going to use the time decay, overnight time decay. Market has closed. You traded, market closed. Done. Next day when the premiums open, they will automatically go down by 1 day, because 1 day ka time decay is there, and weekly options time decay will be of 5 days. Correct. So the entire decay has to happen over the period of 5 days, right? So the time decay would happen tomorrow. Now the problem is, you will say, sir, the time decay will happen, I can understand, but the problem would be that what if tomorrow the market opens randomly at a very high interval? Now you know you are Mr. A, which means you want the stock to be within the limits. That's why you have the iron fly or the iron condor like this, right? This one. So whether you are done iron condor or you are done iron fly, you know that for you, the range bound market is better not outside the range, which means you are Mr. A, not B, right? However, if you are Mr. B, you can do the opposite. You can long, which means you can go opposite. You can long an iron fly or you can long an iron condor if you feel that the market is going to be this and that. But that's not back tested. This is back tested. I've used it. I've made a lot of money with this, and that's why I'm sharing it with you. It's excellent strategy here. What you can do is on Wednesday, okay, just before the market closes, once again, suggestible 3:30 p.m. But if you can start squaring it off 3:25 p.m. to 3:30 p.m. Okay, you can backtest this strategy for the last decade and for the next years to come. If you can predict what can happen using any kind of mock simulator, or there are a lot of simulators available on the internet. You square off this, you do this limited amount of capital, because you are buying 2 calls, you are selling 2 calls. So capital is limited, margin is limited. Risk is obviously limited on both the sides. You can earn more than 100% return in a year, which means if you have started with 2 lakh capital, by the end of the year, you will be having 4 to 5 lakh rupees. Obviously, in every trade, you will not make money, correct? But even if you make money in 6 out of 10 trades, you will get 100% return. If you make money in 7 out of 10 trades or 8 out of 10 trades, luckily, you will have more than 100% return. Your return can go even beyond 500% CAGR in a year. There have been few years where the return has been more than 500% per annum CAGR, which means literally 4 to 5 times. 500% is 4 times your money, your capital. And then you can keep escalating your money. First, start with a small amount of capital, do it with 1 lot, 2 lot, and then you can multiply. Do it on Tuesday, square it off on Wednesday. That's it. You don't need to do anything else. Okay, Thursday would be too volatile, correct? You cannot, you need limited volatility, not high volatility, low volatility. So this entire setup will cost you very low, but it is going to give you tremendously high profit. And which call and put will you buy? Around 200 points up and down. Okay, 200 points up and down, call and put, which means call you will buy 200 points up, put you will buy 200 points down. I think this is fine. So 200 point is good. If you shorten it, it would be too risky. Okay, better to stick to 200 points. All right. Now, if you would have created a short strangle instead of short straddle, it would have become iron condor. You don't want iron condor because we are having just 1 day. Now, 1 day, if you can use your margin, what is the problem? You can rest the entire week. You can do your job. You can be a part-time trader. You just trade once. And how many minutes? 10 minutes. 5 minutes on Tuesday, 5 minutes on Wednesday. Try this strategy. And I can challenge this, that this strategy is going to work excellently. You can use any kind of strategy builders to calculate and understand how the strategy is going to pay you off. The strategy builders can give you random results. It can give you excellent result also. It can give you very bad result also. But please understand that there's no scope for adjustments in this. Now, if you are a positional trader, if you don't want to do this, then you can do iron fly and keep adjusting so that your delta is always neutral, because in this entire strategy, you have to stay delta neutral. And that's a very important thing. So you can use strategy builders which are available on the internet, and you can do that if you want. So the goal here was to explain to you in a nutshell, in a very small, short session, to explain to you the advanced concept of iron fly. Iron fly is the most underrated strategy. People think that it's not a very big, great strategy to trade into. So what is the big deal? It is big deal. But don't do this strategy when you're expecting something big in the market. Let's say, suppose as I said, election results, budget, any big news, big results coming in for big companies, let's say impactful companies, the top 10, 20 companies. That time volatility will be much higher than what you expect. That time, if you want, you can go in the opposite direction, which means instead of going, this is basically your short iron fly, you can go for long iron fly, which means you can become the opposite party, which means instead of selling a straddle and buying call and put out of the money, you can do the opposite, which means you can long a straddle and you can short both the sides. The margin requirement will be very less. And I can show you all of these in details if you come back and learn anything from me, or if you are keen to learn all this, you can always buy some books which can help you to understand these concepts. Okay. Most of the social media and all that, they are all crappy. You will see that people come and talk big, but nobody will try to tell you that simple things can actually make big money in life. They would all want you to, learn complex or complicated things and end up doing nothing. Because this strategy eventually is giving you money in either of the directions. That's the best part of it. Okay. So I have 10 more minutes in the workshop now, and I can take your questions, all of you. So whatever are your questions, just put them up on the chat box if you want to. And if you want, I don't know whether we can allow you to unmute or not, because it's in a webinar model. I don't think that you'll be able to unmute yourself. You can just put your questions on the Q&A. Yes, you can do this on Forex market also, which means currency. It's a strategy which works across. Okay, I've tried it with crypto, commodity, currency, and I've tried it with certain interest rate futures also. Okay, obviously all the products are not available in India, but you can use this easily. Yes, you can get, if you want to, let's say, try out the profit and loss for this, then you can use any strategy builder, because if I would have done this, it would take a lot of time for me to choose the strategies, as in the strikes from the options here. But you can make this same thing, and you can see that the probability of profit also would be very good. If you want to, if I can just try and do that, just give me a second. If I can show you the PNL of this strategy with a strategy builder. Let me just try if I can do that. I cannot tell you who is the best broker for Forex. I'm so sorry, because I'm bound to, I cannot use, I cannot recommend anybody like this. So all the brokers are nice. You should have at least 2 to 3 broking accounts, because when there's a mistake, or when there's a error, or and there's an IT error in any of the broking house, you can switch to the next broking house. Iron fly without adjustments, easily you can do minimum, I'm telling you, for this weekly strategy, if you're doing, you can easily do 10 lots to start with. Easily you can start with 10 lots. Yes, easily you can. Okay. Yes, you are right, this is to be executed on Tuesday and covered on Wednesday. Yes, and call and put should be around 200 points. 200 points, the reason for that is the delta of 200 points would be around 0.15. Okay, so 0.15 is the delta which we want. The strike which has 0.15 delta. Yes. If it is obviously much safer with iron condor, but then the return is also less. And the strategy which I'm choosing, the risk is only of 1 day. So we are mixing the safety of 1 day trade with the risk of iron fly. Correct. Iron condor is often associated with regrets. Here it will not be there like that. Okay. How did I obtain so many degrees? By studying, obviously. So that's how I did. And I'm still studying, and I will continue to study till the last breath of my life. And that's how my endeavor is. I sleep very less, 3 to 4 hours a day, and I study at least 4 to 5 hours still. That's how I do it. Yes, I'll just try to put it on the strategy builder for you. Let me just try if I can do it quickly. Let me just log into the strategy builder for you. And meanwhile, if there's anything else which is coming to your mind, you all can just tell me. I hope that you all have heard me during the entire session. So yeah, so I have just logged into the strategy builder here. This is Opstra basically. So you have certain strategies which is already there, okay, like bullish and all that. The non-directional strategies are also there. Jade Lizard and all that are very advanced strategies. Batman strategy also is a advanced strategy. So we have the long iron fly and short iron fly. As I was talking about the short iron fly with all of you. So this is the short iron fly which we are talking about. This is strategy. Okay. Now short iron fly, if you want to do, so this is the weekly. I'm going to go for the weekly expiry. Let's say so we're going to do the trading for the let's say first week of July. All right. So let's say if we are going to do it for 6th of July, something like that. I can show you here because obviously the market is not on. So I can show you for monthly expiry also. That's not a problem. So if you're going to do this trade for the entire month of July, you can do that also because you have a lot of space left for the premium to decay. That is a very good way of doing this. So if you want to become a trader, it is very easy. You just need to study a lot, whatever is your age or whatever is your stage, and you have to do at least 1 year of paper trading in your age. 1 year of paper trading till you master everything because you don't have money to lose. And then start with small baby steps. Try to accumulate good capital and put it back. Whatever you earn, put it back in the market. And that way start staggering up your career path. Okay. Don't take any loan from anybody. Take a limited amount of capital from your parents and you can start off if you want to. No, I'm not on YouTube. I don't have any Telegram channel. I have nothing to sell to you. Okay. I have nothing, no mentorship program or anything to tell you. Yeah, obviously I'm associated with NSE, I'm associated with BSE, I'm associated with a lot of institutions like Stock Learning, Empirical Academy, a lot of institutions, and they have a lot of courses. And you can always, if you want to learn from me, you can take my name. My name is SAURABH JAIN. You can take my name and you can join the programs. You can join the courses if you want to. I'm quickly showing it to you. I will not be there on any kind of social media. So even if there is somebody in my name, because there have been a lot of fake accounts here and there. So I'm not that person. Okay. What I'm here is for, thank you so much. Thanks a lot for that. See, what I'm trying to quickly tell you here is we have to sell, if you remember, we have to sell, right, at the money. So 19,300 they are suggesting us. We will go for 19,200. Okay. That is what we will sell. We will buy 200 points. Okay. Even though it is not for weekly, if it was for weekly expiry, it is 200 is good. For monthly expiry, you can always extend it to 300 points also if you want to. Okay. Yes, if you want to connect with me, you can always connect. There are various channels here. So if you have joined here through the webinar link here, somebody must have shared the link. You can tell them to connect to me. That would be very good. I think that is one of the best way to connect with me, through the people who have sent you here. If you have joined through some link or somebody's let's say social media handle or whatever, just tell them to connect you with me. That would be very good. Yes. So yes. So let's do one thing. I quickly let me just add this here. I'm going 3 strikes lower in put, and I'm going 3 strikes higher in call. Okay. So I'm going, this is just a kind of a demo. So 19,500. Okay. These are the 2 calls and puts I'm buying, and I'm keeping it as a monthly expiry. Okay. So I'm going to add this position here. Now the payoff is going to be here very soon. So that's your payoff. Okay. That's your payoff here. Now, right now, because the markets are moving into a particular direction, so non-directional strategy would obviously be suffering ideally. Now you have to choose the strikes very carefully. Your duty is to ensure that the delta becomes almost 0. Here we are, it is slightly -5 is nothing, because this is not in this one. So it is like -5 is nothing. It's like, if it could have been -50, let's say, if I remove any of the trades here, it could go there. Now, if you see, the margin is very less. we are doing it for one lot, right? The margin is only 57,000, which is very less. Okay. And you can see the payoff is exactly what we had thought of, right? Now, obviously, we will have to adjust the strikes to increase the probability of profit and all those things. And I'm not telling you to hold this till expiry. You just need to square this off in 2 days, 3 days, 5 days, 4 days. That's it. If you're doing for a monthly expiry, if you're doing it for weekly expiry, I would suggest you to do it, as I said, Tuesday evening. I mean, as in when the day ends on Tuesday, 3:30, and on Wednesday, you can cover your position back. Okay, so that would be wonderful. I hope that you all liked today's session. It was just a small workshop from my side. Just wanted to share this strategy with all of you. Please use this strategy as much as you can. Keep adjusting for the strikes. Try to have this is as close as zero, the delta here, as close as zero. And you do it on a regular basis, you will have a great amount of profit. Great amount of profit. Okay. So I think all your requests that show that I have just tried my best to cover them all for all of you. Now, I would like to call the coordinators here of the webinar to come and address the participants, and I'll take your leave. Thank you so much for the appreciation, guys. It makes my day when I see all of these appreciating words here. This is what keeps me going. Thank you so much, and I tried my best to cover as much as I can on this topic. If I have missed out anything, and if you're coming back we ever meet in any of the courses ever, then I'm going to address all your concerns and doubts. Else, you can always contact the people who have sent you here to contact with me. All right. If you want to connect with me, you can talk to them, please. Thank you so much. Thanks a lot. Thanks for the appreciation. Thank you.
Thank you so much, SAURABH JAIN, sir. Vishal Patel this side. I'm one of the course coordinator.
Okay.
I hope all of the participants have enjoyed and learned a lot from this session. No wonder why we call SAURABH JAIN sir a magician. I'm pretty sure that you all will have a lot of questions regarding the course, price, batches, dates, etc. Don't worry, our course coordinators will get in touch with you tomorrow and clear all your queries. Thank you for joining this session. Have a great weekend and waiting to see you guys for the upcoming batches. This session was conducted by Team Stock Learning in association with Empirical Academy. Thank you so much. You may leave the session. Thank you.